Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. What is interesting about the Canadian investment thesis at this juncture? In the face of mixed signals, tariffs, fiscal stimulus, and policy shifts, markets are navigating a constant push and pull, and the tension is showing up in sector performance. Resources have been standouts, banks are holding steady, and cyclicals have been outperforming more defensive names. So why Canada now? And what is our next guest hearing from our country's top CEOs that might help guide us our way through the next quarter? Happy today to be joined by Portfolio Manager Reetu Kumra for a look at the key drivers moving the TSX and what it may mean ultimately for you and your clients. Reetu manages several Fidelity funds, including Fidelity Long Short Alternative. And just a quick reminder that today's webcast features live French audio interpretation. Warm welcome to you, Reetu.
Thank you. Thank you for having me.
Delighted to have you here and to talk a little bit about the fund itself and also about the Canadian economy that you're investing into, or the Canadian markets that you're investing into. What is kind of the overarching moment, would you say, in Canada right now? You can relate it to investment or just to sort of the broad economic story. But what is this moment?
Yeah, I mean, a good question. I think what I'll do is I'll start off by just talking about the markets in general, and then we can talk about Canada specifically. So we came into 2025, and there was very much a prominent defensive narrative in the market. That's driven by the tariffs that we saw, lack of immigration happening, concerns about U.S. exceptionalism, to name a few other things as well. And all of that led into Liberation Day, and we saw the huge drawdown in the market. And shortly thereafter, we saw a change in the narrative where it became very much cyclical in nature, where we saw tariffs becoming less bad as negotiations started coming out. There was more conversation about easing, whether it's monetary or fiscal easing. The U.S. exceptionalism narrative kind of came back into vogue. And there was conversations about the tax cuts as well as the one big beautiful bill. And so you saw the 35% rebound that we saw in the market since Liberation Day. And so as we look forward in terms of where we go from here, you still have the concerns about tariffs, which are still lingering in the background, but also the USMCA negotiation, which is particularly relevant to Canada. But then you also have on the other side, and this is the push-pull that you had just mentioned, on the other side, you also have fiscal stimulus, one big beautiful bill, tax cuts, monetary easing, and all the tailwinds that could potentially bring out the animal spirits. And so you try to quantify that. The S&P 500, the expectations are EPS growth of high single digits. The index is trading at roughly 23 times earnings. In Canada, we have high single digit growth that's expected as well, where the index is trading at 17 times earnings. And so what we're trying to do in the face of this atmosphere is stock pick our way through the market, where we're just looking at where we see inflections in earnings, where we see certainty of earnings growth, and marrying that with what we're willing to pay for it.
So fascinating sort of approach of the fund itself and how it can help you do all of those things. Remind us, the genesis of it actually is kind of the research itself, isn't it?
Yes, absolutely. So the Canadian Long Short Alternative Fund is a 130/30 long short product. And it really effectively is a fund that packages together our breadth and depth of the research platform. The genesis, as you asked about, it came about roughly 5 years ago, where we had done a study internally on all of the data that we have in-house. And as you can imagine, we have quite a bit. We went back to 2006, and we were trying to identify what do we do well as an investment team? What do we not do well? How strong are we with our stock picking capabilities? So we dissected that data, and as you can imagine, from 2006 up until about 2020, when we were looking at that data set, we've had a number of analysts cycle through a number of different sectors, and those analysts are PMs today. And so it really speaks about our investment process as a whole. And what we found was that we're good at stock picking, but what's interesting is that we do a really good job at our buy rated names, but we do even better with our sell rated names. And we are able to do that with really good consistency and accuracy. And so we thought about creating a strategy such that we can invest in our research and effectively go long on our buy rated names and go short on our sell rated names in order to really capture all the research opinions across the platform. And so we use a rules-based approach in terms of putting this fund together. So we're really trying to just maximize the alpha while managing the risks throughout the cycle. What's a little lesser known about the fund is it actually tilts small cap. And that has to do with the portfolio construction. And so the average market cap of the fund is roughly 10 billion, whereas the TSX is about 45 billion. And so all in all, what you're getting with this fund is it's a Canadian only 130-30 long short fund. It offers that alignment to the market, so the exposure to the market, and also exposure to our research platform. And so we go long on our buy rated names, go short on our sell rated names to really capture that research that has that accuracy, the consistency, the repeatability that I spoke about earlier.
It's so fascinating. And so from there, you then go into sort of the super sectors. Is that
Yes.
how you work that? That's sort of the next
Yes.
the next part of zooming into where you're going to actually invest.
Yes, absolutely. So the way, from a portfolio construction standpoint, I mentioned the directional alignment to the market. So the focus is to be neutral the super sectors. And so the super sectors, as a reminder, are resources, financials, industrials, and consumer. And so we're neutral those super sectors, so we get that alignment to the TSX. And we try to have our research stock pick within the super sectors. And so as a result, the alpha should be generated within the super sectors. And the way it's constructed, and the reason we actually tilt small cap, is we go roughly equal weighted both on the long side and the short side within the super sectors. And so as a result, there ends up being a tilt towards the small cap. What's good about this fund is that it is very diversified. So we cover as a research team roughly 98% of the benchmark, and there's an opinion of those stocks in the fund, whether it's on the long side or the short side. So at any given time, we'll have between 130 to 190-ish positions in the fund.
Oh, okay.
And on the short side, it would be within 40 to 80 at any given time, and that really helps with risk mitigation. As a team, as a research team, to our knowledge, we have the largest research team here in Canada. So we have the ability to turn over more rocks and turn over more stones so that we can cover more securities than any other team, which is actually represented in this fund.
It's incredible. And as you say, this is leveraging the research that you were doing anyway, that was happening anyway. So from there, take us down. Why don't we go through the super sectors a little bit? Because it's a pretty cyclical market at the moment. We've got interest rates coming down. They have been coming down in Canada for some time. There's been some real slashing of rates. How is that married into the story of how you're looking at investments, the cyclical story in Canada?
Yeah, absolutely. Maybe I'll just talk about Canada as a whole, and then I'll dive into the actual super sectors, which are relevant. And so it's just really interesting. I think back to 12 months ago, and consensus was to love to hate Canada, right? Because of all of the headwinds that we have long talked about. And so it's interesting, fast forward to today, and the market's up over 20% year to date, which is incredible. Yeah. So you think about the headwinds that we've discussed.
Almost 30%,
Well, on a year-over-year basis, you're right. Mm-hmm. And we think about the headwinds, they still very much exist. We still have a productivity issue here in Canada, levered consumer, the wall of mortgage maturities is still in existence, although it's not as much of a concern as it was 12 months ago.
We actually don't hear about it at all, as if it doesn't even exist. It isn't a problem. I'm not sure that's true, but it doesn't get much airtime.
It doesn't. It doesn't. You're absolutely right. It does not get much airtime. And then we also have the USMCA negotiation that we have to be concerned about. And so the headwinds are still very much there. But then you look at what the market's doing, and the market is in Canada, the TSX, it's all about the makeup of the market. So you have 40% that are interest rate sensitives, where banks have done extraordinarily well, diversified financials, some select insurance companies. And then you have another 30% that are resources, half of which is gold. And the gold market, the gold sub-index itself has returned 100%. And some gold securities have returned up to 250%. And so copper's also done remarkably well. And so you can see why the TSX has performed the way it has. So getting into the actual positioning of this fund, I can start off with the interest rate sensitives.
Sure.
The way it's positioned is right now with the interest rate sensitives, we're overweight utilities, overweight some diversified financial, select insurance companies at the expense of telcos and banks. And so with the utilities, they're very steady businesses. The valuations aren't hugely demanding. You could potentially have an AI kicker on select names as they have exposure to U.S. infrastructure built out, as well as power. And so, we have an overweight there. Diversified financials, through the cycle compounders, really good quality businesses. And so we try to stock pick our way through the valuations there. Insurance companies, very selective from within the insurance companies. Mm-hmm. And then this is all at the expense of telcos and banks. We recently met with the banks at the first week of September, all the CEOs of the banks, and there's cautious optimism there, where they're seeing the earnings come through, and so
it's such a litmus test for the economy.
Yeah. I think that they're seeing a decent amount of loan growth. The fee-based businesses, like whether it's capital markets or wealth, doing really well. Leveraging expenses, capital positions are good. No huge red flags on credit. I think they've all taken their provisions, and so there's cautious optimism. But with the caveat is that there's the USMCA negotiations that are coming up, so let's see what happens. But for this fund, we also have to marry that with what we're paying for these stocks. Okay. And so we're trying to stock pick our way through the banking sector there. And then telcos have just been challenged, just given the competition and the pricing environment within that super sector.
And that's been that way for a long time. It's tied to the immigration story, as you said. It's any light at the end of the tunnel there, or is that a little bit of a just sitting there?
Yeah, I mean, it's been a challenge sector for the last several years, where not only do we have immigration coming back down, we also had a fourth player come in through into the wireless segment, and so it increased competition materially. And so I would say that it's better than it was like last year or 2 years ago, but
there's some assets that were shed and so on.
Yeah, we're still not out of the woods, and these businesses are highly levered. And so again, stock picking our way through it, trying to look for idiosyncratic upside, and keeping in mind what payouts and balance sheets look like, and coupled with valuation.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Let's go to the sort of industrial side of things, which encompasses so many different areas within. But transports also have been that story where it's almost like a COVID hangover that hasn't really lifted at some level.
Absolutely. So within the industrial super sector, there's industrials and tech. The fund is largely neutral, both those sectors. But specifically within industrials, had you asked me earlier on this year where our exposures were to, it was likely a little bit of the capital goods space and more so the professional services space. Now I would say the exposure is more capital goods and transports. And so what we've done in the fund, and this is all led by the research, is that we've seen the move from a little bit more defense to a little bit more cyclicality. And so, and that's reflected in the industrial sector. Yeah. And so transports it's interesting, just as we were talking about before we got on air, is that if you look at the cyclicality, the cyclical trade that's happened in the market, the two areas of the TSX that has not participated are transports and lumber. And so rails would fall within the transport sector. So you're right, it's the COVID overhang. We've been in a freight recession for a number of years, and the U.S. tariffs and the uncertainty around that, around USMCA negotiation doesn't help. And so
on the lumber side, though, I mean, that's been a political football for some time, decades actually. But what does it have better prospects?
Well, so lumber has been extremely challenged. You can see what the stocks have done year to date. Yep. That sector is an interesting one because the fundamentals are not great. We in fact just had the outcome of Section 232 come out last night. And there's an additional 10% tariffs that are coming in the lumber space, but the outlook doesn't look great. But I think the important thing to think about is at what point are you just paid to wait? You don't necessarily see where the stock or when the stocks are going to inflect, but as long as you have balance sheet visibility and you're getting stocks at a discount, you're just paid to wait. Right. So it's an interesting sector.
So that might be a better place to be paid to, because yes, as you say, other things became sort of value traps ultimately, but that might be a slightly more interesting one.
Yeah, I mean, I think valuation's on your side.
Yeah, okay, valuation's on your side, I like that. Very good. Okay, well, let's go into sort of the materials side of things within resources. You mentioned gold, you mentioned copper. Yeah, I mean, I think when people have been thinking of Canada, gold has been a massive part of that, obviously.
Absolutely.
And it's been the trade or one of the trades. Any reason to see that interrupted?
Yeah, I mean, we are within a stone's throw of $4,000 gold, which is we're effectively at all-time highs at this point, which is why you've seen which is why you've seen the gold index, the sub-index, do extremely well year to date. And so why is that? Okay, so the list is long. We have real rates that are going down. Mm-hmm. We have fiscal stimulus. We have potential monetary easing cycle ahead of us. We have questions of Fed independence coming into play. We have a de-dollarization theme. We have central bank buying across the board. And so when you have an environment and a setup like that, where there's a movement away from the US dollar or fiat currency, investors tend to want to go into real assets. And that includes gold, includes other asset classes like Bitcoin. And so that's why you've seen the performance that you have. And so, if you name off all of the items that I just mentioned, if there's a view that will continue, then, then gold looks interesting.
Okay. So there's no real reason to go into that. So let's go to sort of the AI theme, which is in everything. Mm-hmm. And for Canada, it's probably much more of, at this point, a power generation to actually power the AI data centers, basically. Uranium has been much discussed over the course of the last year. You almost wonder if that's sort of over, because it sort of rose and then, gosh, it's going to take 10 years actually to build certain reactors. I mean, do we kind of wait a little bit on the valuation side? But what do some of the uranium-linked and reactor-linked stocks look like?
Yeah, I mean, that's a really good question. So uranium, I used to cover uranium way back when, and it was such an interesting commodity because there has been no supply that has come on for decades. And so since the unfortunate events of Fukushima. Yeah. And so when you have a situation where you have no supply and then all of a sudden there's this demand tailwind, it really sets up it's a good setup for the commodity, right? And which is what we've seen in uranium. Fortunate for Canada, being resource-based, we have one of the best ways to play uranium globally and from a publicly traded company standpoint. And so I think the setup for uranium continues. I mean, you just heard the Trump administration talk about wanting to bring on more reactors, like 10, I believe it was 10 more reactors by 2030, if I'm not mistaken, if my numbers are right. And so
that's a quick turnaround, I understand.
Yeah, and you also have uranium itself is just such it's considered a green commodity, and it's one of the most densest, most efficient forms of power that you can have right now. And so I think the setup looks quite attractive, and I think the rate of change is positive.
But is there a lull, I guess? That's sort of the question. It seems, and you could even expand this discussion out to perhaps the Canadian hope for major projects. We don't know where exactly all of that is going at this point, but it seems to be that if we can get through a period of time, things are going to pick up with some spending, some government spending, and maybe investment on the other side. And AI is a big theme within that, the sort of build out for that. Is there a gap here? We have we've got stock market sort of on fire here, but do we have a period where there's a bit of a lull, I guess is the question.
I mean, it depends. Like it's difficult to say. It depends on permitting. It depends on construction. It depends on so many different things. I think for now the theme is quite alive. It also depends on hyperscaler spend, right, on data centers, right. So there's a lot of moving pieces to be considering. But I think over the medium term there might be a lull. But if you think kind of in the medium term, I think the rate of change is positive. Okay.
And what do you think of sort of those ideas of things hanging out there as projects and things to be built to sort of build up the infrastructure of Canada? Are they of interest?
Yes, absolutely. That's particularly relevant in the industrial sector, where there's a number of different ways to play that, potentially even the energy sector as well. And so if we end up getting more public infrastructure spend, which looks like will be the case based on some of the projects that were announced a few weeks ago. That could be really interesting theme to play, and something we're definitely analyzing and looking out for.
You're getting a question just on that right now. So just your thoughts on the energy sector, specifically with the development of power demands of the AI boom, like where it all goes, how it gets used.
Yeah. So I mean, with the energy sector specifically, we have oil and we have gas, and so with oil, I just think we have too much of it. And so
from a pricing perspective, there's just a lot.
Yeah, there's just a lot of it. OPEC just came out this morning talking about accelerating the hikes. Yeah. And so I think there's just a lot of spare capacity, although demand has been hanging in there, just given...
There's been a few interruptions here and there.
There's been, of course, there's geopolitics that we have to keep in mind. But in general, that's my view on oil.
Gas is on rock bottom prices. But that said, there is sort of, we think, a future in terms of the infrastructure to get it out.
Yeah, absolutely. I mean, we're just waiting on LNG, LNG phase 1 to come on. And so that's expected to come on in the coming months. But in the meantime, we have a glut of gas here in Western Canada. The good news is that with some of the projects discussed, there could be a phase 2 of LNG coming in the future. And so let's see. But in general...
does that become a picks and shovels story a little bit? Like how to get those terminals built to then get rid of the LNG to Europe or wherever it's going?
Yeah. So I mean, like any of this infrastructure spend is great for Canada, right? It's just great for our GDP. It's great for job growth. And so I think that, to the extent that we were able to get LNG phase 2, that would be good for Western Canada as well. But that's kind of a medium-term story, I would say, because if you think about how long LNG phase 1 has been in progress for, it's been a while.
So take us back to the positioning, and then I just want to ask a little bit about crypto, because this is one of the funds that you manage as well, and something you've spoken about a lot of the past 4 or 5 years. But take us through the positioning. It's a long-short fund. If you're overweight something and underweight something, does the underweight mean that's kind of a short side of the portfolio? How does that work?
Well, so it could be. So if I'm overweight, then it's obviously long. And so if I'm underweight, it could just be I'm overweight, just a smaller position than the benchmark, or it could be that it's a short. And so it just really depends. And then your other question was crypto.
Yeah, let's get into crypto for sure. Bitcoin has been extraordinary.
Yes. And
along with gold.
Absolutely. So I think Jurrien Timmer puts it so nicely, where Bitcoin and gold are 2 players on the same team. And so interestingly, Bitcoin and gold actually don't have that much of a high correlation, but the drivers are the same. And what I would say is Bitcoin is kind of that emerging store of value, whereas gold is just very much a store of value. And it's been around for quite a long time. And so the drivers are the same. Everything I talked about in terms of gold,
sopping up the liquidity that's out there.
Yes, like the M2 money supply, it drives Bitcoin. What I would say is that there's a little more of a story to Bitcoin, because we just talked about the demand perspective from a developed market perspective, but there's also the undeveloped markets that we don't necessarily have visibility to, just here in Canada. And what we don't know and what we don't necessarily see on a daily basis is like 22% of the globe being unbanked. and the residents of countries that are more developing, not necessarily having a currency or a central bank
that they can depend on,
or having runaway inflation. And so you want something outside of the fiat currency system that drives the demand of Bitcoin. On the supply side, which is interesting, is that the inflation of Bitcoin is just under 1% after the last halving. And that supply is going to go down every 4 years. The next halving is expected to be in 2028.
And that's scarcity.
Yeah, so there's a scarcity value there. And so you have, on the demand side, you can see why there's demand for Bitcoin. And on the supply side, it continues to go down. And so the volatility of Bitcoin is more of a feature, but not necessarily a bug.
You also manage the Ether fund as well, which we don't talk about as much.
Right.
But I've heard someone, curious to your comments, to talk about Bitcoin as almost being like fixed income, or there's a scarcity, it sort of holds, and then the actual currencies that we spend will be more stable coins connected to Ether and that side of things. Does that sit right with you?
Absolutely. So stable. Maybe we should take a step back and talk about what's been happening in the crypto market a little bit. So back in 2024, we really saw it go off to the races because we had the halving event, but we also had
all
ETFs.
The ETFs in the US.
All the ETFs come about. And so it became an easier pathway in order to invest in crypto. And you saw a little bit more in the way of institutional involvement as well. And then you fast forward into 2025, and you've had deregulation, which has been great. And so we got SAB 121 that was repealed. And then, so that's what I mean by deregulation. But you've had more regulation in the sense of the stablecoin bill, the Genius Act was approved.
The whole summer was full of layers.
Yeah, and right now they're trying to work on the Market Clarity Act. We had the Bitcoin Strategic Reserve announced, the crypto stockpiles. And so you're seeing a more friendly administration coming out of the US, which has really driven the crypto market. With the stablecoin bill, stablecoins are effectively, Ethereum has the dominant market share of how stablecoins are transacted. And so that's why we've seen the tailwinds of Ethereum.
Yeah. So it's an interesting sort of comparison. Where does that belong ultimately? We talk about the fund itself, but also an amount of crypto. Where does that belong, do you think, in an investor's portfolio today?
Yeah, so we've done a lot of work, Fidelity as a whole, on how to think about Bitcoin in terms of its placement in a portfolio. And what we've seen is that if you just put a slice of Bitcoin, whether between the 1% and 3% range, you rebalance it quarterly in your traditional 60-40, it could increase your Sharpe ratio, which is a measure of risk-adjusted returns, by over 30%. And it tends to have, there's times where it's correlated with other asset classes, but if you look over a long period of time, it tends to be uncorrelated. And so Yuri and Timur has historically talked about the 60-20-20 as being a new way of balancing portfolios, where 60 is equities, 20 fixed income, 20 alternate liquid alts. Yeah. And I think Bitcoin could fit into that, a slither of that liquid alts piece right there.
And the fund that you manage, the long short that we've been mentioning, do you think of that as, where does that fit within that continuum of 60-20-20?
Right, so it's considered a liquid alts portfolio because of the ability to short within the fund. I personally consider it very much a core Canadian fund. And so again, just going back to the value proposition of this fund, it's a core Canadian 130-30 long short fund, offers directional alignment to the TSX, and really owns our research platform by going long on our buys, short on our sells, and really owning the strength of our research.
It's brilliant. It's really fantastic to speak to you at this particular moment, Reetu. Thank you for joining us here today.
Thank you for having me.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.